abolition of angel tax, a single rate of LTCG at 12.5% for public and private unlisted shares. I think we are meeting today in a situation where India has sent a very clear signal. We want growth in private capital, which means investments in startups and growth equity. And we want to send a signal that we like startups, we love startups, and we will do whatever it is possible to encourage startups. Given that fintech and financial services account for more than 20% of investments in startups and growth, I think this is a great note on which we can begin our conversation today.
Absolutely, Gopal. And I think, as you rightly pointed out, I think the government is making all the right noises and is actually, in a way, nudging the country into the right direction. And to your point, fintechs have always been and will continue to be a very significant part of our both our financial services ecosystem, but also of our sort of growth tech ecosystem. And within that, as I look at it, I actually am quite amazed at how large India has become. And so while the rest of the world actually has seen some, I would say, slowdown as well, India continues to, in a way, chug along on this whole fintech journey. And I think it's a fascinating journey. And therein lies both the opportunity and the challenge for us, which is how do we continue this journey at the breakneck pace that I think India needs and deserves, while at the same time keeping in place, all the balance and the checks and balances in place. What do you look for, right? What's top of mind for you when you start assessing whether a certain fintech is worth investing in?
So I would say two things other than the commercial angle, right? Because that's obviously a filter, but it is just a filter and not in some sense a driver alone, because it can be made to appear whichever way you want. First, obviously, is for us, we look for the entrepreneur quality. We call that as a AAA entrepreneur quality. Ambition, I would say unapologetic ambition at times. Ability to execute, because India is full of ideas, India is full of opportunities. People who have the bias for execution rather than the bias for the next brighter idea are far more valuable as far as investors and businesses concerned. And the most important thing in the day, Alpesh, which is fundamentally like you are at BCG in consulting, the ability to attract, motivate, retain great teams. Because gone are the days of the Lone Ranger riding with Tonto, right? These are the days when we have the Panchapandavas. And that's who we can make success. Third thing that is emerging more and more important, and has nothing to do with the company or the entrepreneur, Alpesh, is who is the cohort of other investors along with you. Today, the dharma of investing has become a group dharma. Everywhere we have 3, 4, at least funds we are with. Now, if those funds cannot work together, sing together, play together, fight together, it's going to be a very, very tough challenge for us. So we know that 2, 3 funds we worked with where we're very easy to have a rational conversation and solve problems.
Is there a difference in how you look at it when a company is, let's say, in the startup mode to when it's getting to, I don't know, Series C funding versus when it's getting to a very much larger business? And, from a company's perspective, how should one, think of this cycle? And, how does the access to capital either become easier or more difficult? And how do the modes of access change, right?
I think the most important thing for us is, from investor angle again speaking, is the portfolio design. There is space in the portfolio for growth investor. Typically, a growth investor has a dozen investments at most in one particular fund. There's about a space for 2, 3 investments, maybe 4, based on team sizes, where fundamentally one can become true partners in that business. Okay. So I would say that's a partnership. The spirit of partnership may be pervasive, but this is the group where you're actually spending time as partners, right? So these are generally businesses which are also have a fair amount of space discovery built into it. They could be at a Series B, as far as we are concerned, or they could be in what we call as a born adult mode, or we call as a first check franchise. Now, let's say somebody called Alpesh wants to leave, let's say, a leading consulting company. Let's call it ABC, right? Now, that individual with that experience is now becoming more and more a common phenomena in our business. Teams leaving companies, starting on their
Right.
own. Uh, Somebody with a very eminent track record of execution in their early 50s coming out and wanting to start. So we're actually seeing a big shift. If you take 2005 to 10 era, it's all first time founders, right? 15 to 20, you start very serial founders, serial entrepreneurs. Now, I think in the 25 time, we're actually getting born adult founders. So actually, they called Series A or seed, kuch bhi bulao unko. But
Right.
actually, they are born adult. So, and a minimum check at the first check is 200 to 300 crores.
And looking at the other end, how do you think about exit? Because when you look at this whole capital access overall, right? And I know it's early days because we actually haven't hit too many sort of exits or the end of cycle for some of these investments. But it's equally important to be able to get that because then you can actually get back into some of these. Right? So, uh, what's your take so far? Is India ready? Because if I look at the number of companies that have IPO'd, it's still limited, right? And
That's a
so,
very, very good observation, Alpesh. Yeah. I think two things, right? First is 12.5% LTCG. There's another message from that, which is people have become indifferent to whether the exit is through IPO or through secondaries.
correct.
Yes, secondaries will have a discount, but there's a certainty of liquidity, no doubt, compared to an IPO. The main difference now become discount and not taxation. So from that point of view, when I look at the data that our team looks at, more, I say 10% of say NBFCs are likely to come to IPO compared to maybe a very small smidgen of companies from say consumer finance, consumer loans. I keep saying loans and finance. What I meant is consumer product companies, right? Maybe 0.5% come to actually the stage of IPO. So I think as you also observed your own study that it takes minimum of 6 years for people to find IPO. I am not worried about this one area at all because I look at last week's IPOs. You look at Unicommerce, what happened? You look at First Cry, which is a late stage IPO, what happened? 45% pop on day one, right? Unicommerce has popped even more than that. So I think that is not a concern to me. Indian market is showing extraordinary appetite for smaller companies. But what is a concern to me when it comes to lending in particular is company size. Because to build a 5,000 crore book was enough for an IPO 2, 3 years ago.
Right.
Maybe it's a 10,000 crore book. But then stop. Number of NBFCs is more than 10,000 crores. Is a maybe what, 25, 30,
2025, yeah, exactly.
something in that order of magnitude. So that is worrying me, which means time to build that kind of book or consolidate that kind of book may be becoming more and more important. And to build a 10,000 crore book is, at least a 7, 8, 9 year,
It's
10 year
280
journey.
or 20, absolutely. And maybe even 10. It depends on.
Yeah.
If you get it right the first time around, then maybe it's a 6, 7, 8 year thing. If you don't get it right and you're making a few changes, then it's a 8, 10 year journey. So, yes. The other struggle that I also foresee, right, is for every five great companies, and we'll be talking about some of them, you'll always have two or three which are exploding, right, with poor behavior and poor transparency and so on. And so that's also what sort of leads to concern saying, are you thinking of it the right way? So, what do you think, from a regulatory government and investor and company perspective, we would have to do to actually achieve this full potential that I think India needs and is due for, but it's still going to take a lot from all of us. So, if you take these four different stakeholders, your take on what we would need to do?
So let's take a torchlight and walk from the beginning of the value chain, just raising money to the fund, to the company, to the regulator. Let's assume that these are the four stages, right? And let's call the name of the torch as alignment. We're looking for alignment with long tenor. So first torchlight is when we go to see the person who provides the fund, the institution. Indian entrepreneurs have built India, if nobody can disagree with that statement. But there's a time has come for us when the wealth of those entrepreneurs cannot be the only way in which we can raise money. They have been amazingly visionary and with a deep sense of not only wanting to make profit, but also to give back by giving money to funds because other entrepreneurs are going to be born. In India, the families have been very far-sighted, I would say. They know that they can get maybe the same or even higher return from their own business but they give money to fund managers saying, दूसरों को भी पैसा मिलना चाहिए. That kind of mindset is there, and they want to give it meritocratically, and they see the fund as a route to give it meritocratically, which
Right.
they could not do because they don't have time. They're running for business.
I
They
don't
don't
know.
have time to do this, right? So we need to move from them alone to basically EPFO money. The only aligned money in India for 20 years, 10 years is the pension money. Across the world, 10% to 20% of money to funds comes from pensions. Pensions and maybe endowments. India endowments are still early,
Very
but
small.
there are 21 trillion rupees sitting in pensions. 10% is 2 trillion. The total value of drawdowns made in rupees from AIFs from the beginning of time is 2.5 trillion. Just to give perspective to this number. Right? Insurance moving very well. IRDA has been visionary. We're getting a lot of insurance checks. Some bugs are there, but by and large going really well. So I think we need to unlock pension in the first. Second level, basically coming to funds. I think fund managers are ready for it. Our new fund, Alpesh, is a 12-year fund, basic fund, which
Okay.
means even our last investment will have 8 years left.
We'll have 7, 8 years left. Yeah.
So if we design a portfolio well and take the small companies in the beginning, we'll be doing 9 to 10 year olds, which is better than or as good as the best American growth funds. So funds are ready, but I think from the funds point of view, they're still worried and some fears still exist about income tax notices, particularly on areas like carry,
Yeah.
both in terms of income tax and GST. Third is, as far as companies are concerned, I really think the fintech industry is going to become more of an adult game. People who have worked with regulators, seen regulators, who understand that regulator is not a friction for them, but actually a friend for them in terms of compliance, actually be. So I would say adult people who understand. As far as regulator is concerned, I think SEBI on IPO has been fabulous. Unicommerce is a 110 crore company which got listed, doing spectacularly well, right? So I don't think there's any problem with SEBI or anybody in that sense. I think the regulators have been friendly. One thing they can do, Alpesh, is that the entire trading in unlisted shares, if we can put it on some kind of platform like the debt RFQ platform, where there's a visibility of trades taking place and the trail of history, itna share, usko beja, this was the price. That would give a lot more comfort on secondary. So secondary is developing through a platform. Secondary funds are beginning to come.
So even if I take startups now, the way I see it is companies that can actually get the best of both sides, right? The exuberance, the ideas of the youth, as well as the maturity and the experience of the not so young ones. If you can combine that, these companies will laugh all the way to the bank, right?
The older person is there because of what we call IPR at TCF, intuitive pattern recognition, what we call expertise.
Yeah.
The person has got skills, energy, enthusiasm. But the expertise should become a aid and not a block.
Absolutely. No, see, that has been the problem with if I call it that, the incumbent businesses, right? Where all the decision rights are with the 40, 45, 50-year-olds, right? Whereas in the fintechs and the startups, you'll actually go the extreme other way, saying, hence, we will actually shun the 40-year-olds.
Right.
Getting the balance right to your point where uh, you combine the best of both worlds, I think is the journey ahead. So Gopal, one last thing, right? If you were to look at this whole theme of, and I know we've discussed that, but if you wanted to summarize, saying if you wanted to, you know, just take one point, which is the access to capital, and how do you identify or bridge this whole, uh, you look at the next decade and say India has to go places. If you had to give 2 or 3 tips to the audience to say, what does India need to do to make sure we're able to meet the capital requirements of this journey?
So, Alpesh, I think, like I said, first is the availability has to keep increasing. So today, for example, out of 10 trillion rupees of committed capital in AIFs, 5 trillion is rupee and 5 trillion is not rupee. This is what SEBI data has recently revealed. Out of the 10 trillion, 5 has been drawn down. So you can again run the math. So it's not a bad start, but we need to basically get long-term capital much more. The
So you're saying
second,
different pools, sorry, just to finish, you said the first point is access to different pools
Yeah.
both AIFs slash, EPFO slash
Right.
insurance getting access to broader pools of money.
And therefore, what I'm wrapping that round is the idea saying domestic capital is the one that will be able to take a very different set of risks.
Right.
Maybe it's 60%, 70% domestic, some foreign money. But domestic manager, domestic capital is the one who can actually make the big change to the way the industry behaves. The second thing I'm going to look at is basically the fact that I think the regulators have played a very positive role, especially RBI more than anybody else in terms of looking at fintech, setting up a fintech department, starting sandboxes, RBI Innovation Hub. I think if we can get orchestration across regulators of the startup mindset, right, it has a lot of power to change the country. For example, today, all distribution is largely touch in India. Now it's moving from touch to tech, or rather tech with touch, whichever way we want to put it. In that situation, the distribution channel in the market is not defined by a regulator, but by what the customer wants. My third point, and that is, I think, what now India is now waiting for is, you can call it DPI 2.0, DPI 3.0, then give it whatever X.O chair. But I think after Aadhaar, right, Jandan, mobile, UPI, we need one more such booster. Account aggregator is clearly not the booster, right? We need something bigger than that from a booster. And the two big ideas that occur to me there, one is a national financial information repository or a national financial information aggregator, right? A federated aggregator of some kind, right? I think that is what would make a huge difference. So whether it is the PTP FCC of RBI making available federated information in a very simple one pool way, or whether it is Governor Shaktikant Das's vision 2 budgets ago saying we would create an FIR, or in addition to that, one more big idea is, can we have a RegTech backbone in this country where supervisors and regulators can digitally keep examining on a real-time basis, daily basis, just automatically at a transaction level granularity, what is going on, and flag things much before a hue and a cry is raised saying, oh, systemic risk has come to our industry, we have to put an end, and there has to be a statement at the MPC by the governor. RBI is doing a fabulous job. I'm a big RBI fan. But we can actually help RBI get more comfortable. And the more comfortable, as we know, you're a very well-known coach for senior executives. If the CEO of the company is calm, you know that there is much more likely of success.
Yeah. The first one, I guess, is difficult, but it's a stroke of the pen.
Yeah.
The second one is a little more complicated because it impacts a lot of individuals as well. But I think this whole orchestration across regulators. And the third, as you said, which is, if I take information and data, is there a booster? And I like your word which says, what's the UPI equivalent for that? What can we do with that? So I think those are three that you point out. And hopefully if we get that, then I think this projection that we were trying to make, which is fintechs will be 200 billion in India by 2030, we will be far off. I would love to be wrong, and I hope it's 300 and not 200.
Absolutely. 20 trillion. Yeah, it should be 20 trillion rupees. That's what the number I like to use, because we need about 46 trillion of new capital to get funding for all of the its ecosystem. And at least 20 trillion should come from fintechs or rupees. Yeah.
So anyway, I guess that's
Thank you, Alpesh.
Thank you. Thank you very much.
Pleasure talking to you.